Let's go ahead and go through the solution to the first practice problem from Module 6. And this involves the sale of a differential asset. So we have a partially owned subsidiary acquired at other than book value. We have a number of differential items. We have some undervalued land, we have some undervalued equipment, an undervalued patent, and there's some goodwill. At the end of the first year, the goodwill is impaired, and a third of the way through the second year, the undervalued equipment is sold, and we need to go ahead and account for these two events. First, let's go ahead and go through our fair value versus book value equals differential analysis. Our 70% cost $350,000, the total fair value is $500,000. The book value is $400,000, our share $280,000 for the differentials as indicated. And again, why does this differential exist? First, there's the undervalued equipment, undervalued by $30,000. That's going to be amortized over 5 years at $6,000 per year. Our share of that is $21,000, amortized at $4,200 per year. There's also land, undervalued by $20,000, our share $14,000. There's an undervalued patent with a 2-year life, $10,000, amortized at $5,000 per year. Our share $7,000, amortized at $3,500 per year, with the remainder being goodwill of $40,000, our share $28,000. And again, here's just sort of a summary of the information that's relevant, and let's go ahead and go through our equity method entries for 2021. So first, we have our share of Little's reported earnings. 70% of $50,000 is $35,000. And then our various amortization charges. First, the equipment amortization. Again, the total amortization was $6,000, our share $4,200. The patent amortization, our share $3,500. And then finally we had an impairment loss. Recall that the impairment was initially recorded at $40,000. Sorry, the goodwill was initially computed at $40,000. It was determined that it had to be written down to $10,000 at the end of the first year, so we needed a $30,000 impairment. Our share of that $30,000 is $21,000. Okay, let's go ahead and go through the elimination entries for 2021. First, with the S entry, as always, we eliminate the subsidiary's beginning of year equity accounts, common stock and retained earnings. And we're going to go ahead and record the differential, various differential assets. Now first, note that the problem said that the undervalued equipment had accumulated depreciation of $50,000 at the date of acquisition. So we need to get rid of that accumulated depreciation. Again, when a separate accumulated depreciation account is used, we want to make our books appear as though this had been a merger. And if this had been a merger, we would have not carried forward the acquired firm's accumulated depreciation. We'd start with a clean slate. So basically what we're doing is we're negating, or crossing out or eliminating the date of acquisition accumulated depreciation. Now the equipment was undervalued by $30,000. This $50,000 debit to accumulated depreciation is going to increase the book value by $50,000. So to get to a net $30,000 increase, we're going to go ahead and credit the equipment account for $20,000. So again, between the $50,000 debit to accumulated depreciation and the $20,000 credit to equipment, we're getting that net $30,000 increase in the value of the equipment. We record the increase in the land value, we record the increase in the patent value, and we record that $40,000 of goodwill, soon to be impaired. Now that total of $500,000 net, we split 70-30 between the investment in Little and the non-controlling interest. Next we move on to our amortization entries, and just going in order, the equipment being written off at $6,000 per year. Again, we're using a separate accumulated depreciation account, so we debit depreciation expense and credit accumulated depreciation. We go ahead and record $5,000 of patent amortization, and then we take that $30,000 impairment loss on the goodwill. Now we need to go ahead and eliminate the parent's investment income, and again, you can go through those equity method entries from the previous slide, and they add up to $6,300. Or you could go ahead and do this in the same manner that we do the income to the non-controlling shareholders. We say, look, the subsidiaries adjusted earnings, we start with the reported earnings of $50,000. We subtract the additional depreciation expense, we subtract the additional amortization expense, and we subtract that $30,000 impairment loss. So the net result of that, $50,000 minus $41,000, $9,000. That $9,000 is the subsidiaries, in a sense, adjusted or revised earnings, and the parent is going to get 70% of that, or $6,300. And again, that corresponds with the result of our equity method entries on the previous slide. Similarly, for the income to the non-controlling shareholders, again, the subsidiaries adjusted earnings are $9,000. The non-controlling shareholders get 30% of that. Now, I want to go ahead and go through the elimination entries for 2022 sort of in parallel, and this way we can sort of refer to the 2021 information to see how it carries forward to 2022. So our elimination entries for 2022, again, we eliminate the subsidiaries beginning of year owner's equity accounts. The difference here is that Little's retained earnings has now risen to $400,000. Accumulated depreciation. Again, think of how the accumulated depreciation carries forward from last year. Last year we debited accumulated depreciation for $50,000 and then credited it for $6,000, carrying forward a net $44,000. And again, we still carry forward that $20,000 credit to the equipment account. Now again, if you net together the equipment and the accumulated depreciation we've got so far, we come up with a net $24,000 debit. That is the remaining unamortized equipment differential. We carry forward the land of $20,000 and the remaining unamortized patent, and we carry forward the remaining unimpaired goodwill. That total, we again split 70-30 between the investment and the non-controlling interest. Now let's go ahead and see what we're going to do with this equipment differential. Now again, we're going to be selling this equipment on May 1st, or we're looking in hindsight, this was sold on May 1st of 2022. So that $24,000 equipment differential, again, $44,000 debit to accumulated depreciation, $20,000 credit to equipment, that net $24,000 equipment differential needs to be gotten rid of because the equipment is no longer ours. Now a portion of that we're going to depreciate. We sold, or Little sold, this asset on May 1st, so they would take 1/3 of a year's worth of depreciation. The depreciation rate on this was $6,000 per year, so 4 months worth at $6,000 per year would be $2,000 of depreciation expense. Now the remainder, again, the equipment has now been sold, so we need to get rid of all vestiges, all evidence of this equipment. So we're going to go ahead and debit the equipment account for $20,000. That undoes or negates the $20,000 credit in the initial entry. And look at the accumulated depreciation account. In the S entry at the top, we debited accumulated depreciation for $44,000. We then credited it for $2,000. So we have a net $42,000 debit that we need to eliminate. So we're going to get rid of that by crediting accumulated depreciation for $42,000. The net there, $42,000 minus $20,000, $22,000. That $22,000 remainder or difference is the remaining unamortized differential as of May 1st. That additional asset value is not going to be realized. We're going to go ahead and treat that as an adjustment to the gain or loss on sale of the asset. Now, just pulling numbers sort of out of thin air, what if Little had reported book value of $100,000, and based on our records, we thought it was worth $122,000. Again, that's that $22,000 differential. They sold it for $130,000. So on Little's books, they're going to have a $30,000 gain. Something was on their books at $100,000, they sold it for $130,000. From our perspective, the true book value of that equipment was $122,000. So from our perspective, there's only an $8,000 gain. So what we're doing here is we're reducing the reported gain on sale of the equipment from what Little is reporting at $30,000 down to what we think the true value is of $8,000. In any event, we continue on. We take our second and final year of amortization expense on the patent, And then we need to go ahead and eliminate our investment income. And again, let's do this the same way we did in 2021. The parent is going to bear, or is going to be allocated, 70% of Little's adjusted earnings. So they have reported earnings of $60,000 minus $2,000 of depreciation expense minus $22,000 of that debit to the gain on sale, reducing the gain, minus $5,000 of amortization expense. So their investment income will be 70% of that, or $21,700. By the same token, for the non-controlling interest, they're going to get 30% of that amount, or $9,300. Finally, let's go ahead and do our equity method entries for 2022. Again, big company is going to report their share of Little's reported earnings, 70% of $60,000. They're going to report their share of the $2,000 partial year depreciation on that differential equipment. They're going to report their share of that $22,000 gain adjustment. Again, we reduce the gain, so we reduce our investment income. And then finally, they report their share of the $5,000 amortization of that patent differential.